Welcome to the Wall Street Lab podcast, where we interview top financial professionals and deconstruct their practices to give you an insider look into the world of finance.
Hello and welcome to another episode of the Wall Street Lab podcast. My name is Andy, I'm your host, and today with me is my guest Jean-Christophe, or easier JC the Swaan. He is a lecturer in the economics department at Princeton University, where he is affiliated with the Bentham Center for Finance. He teaches courses on ethics in finance and on Asian capital markets to undergraduate and graduate students. He also teaches at the Judge Business School at the University of Cambridge. In the past, he has taught at Yale University, Kong UST, and Cheung Kong Business School in Beijing. Separately, JC the Swaan is a partner at Cornwall Capital, an investment fund based out of New York. And prior to Cornwall, he was a senior advisor on China at Global Macro Fund and investment professional at Asia Dedicated Hedge Fund. Prior to that, JC worked at McKinsey Company. He received a bachelor from Yale University in political science, a master in philosophy in international relations from the University of Cambridge, and a master in public policy from Harvard University's Kennedy School. He is also a member of the Council on Foreign Relations and an associate fellow of Ezra Stiles College at Yale University. And he is also the author of Seeking Virtue in Finance, Contributing to Society in a Conflicted Industry. JC, welcome to the podcast. It's such an honor to have you here, and it's really cool to talk to you today.
Great. Well, Andy, thanks so much for having me on your podcast. I'm excited to be here today.
With what I just spoke about, with your background in political science, international relations, why are you teaching finance? How did you get into that? And why this combination of financial ethics and Asian capital markets? Let's maybe start with that.
Yeah, it's an unusual combination. The genesis of this is that I've always been interested in public policy. My entry point into the investment world was really this notion of finance as a force for good. As you mentioned, I studied public policy, political science, and I ended up focusing on finance and emerging markets, and I really wanted to understand how finance can be a force for good, how it can help nations prosper. And as I thought about different career paths, one of the things that got me really excited was going into finance and trying it out and trying to understand at a granular level how finance can be helpful to society, to people. I started by, you mentioned I worked in management consulting for a few years after school. I ended up moving to the buy side to try to test out this idea of finance as a force for good by working in a long-short equity hedge fund that was dedicated to Asia. And so we were investing in all markets in Asia, mostly emerging markets as a result. And that was my first foray. Out of this was born an even greater interest to understand things, because it probably took me a week or two on the job to realize that I would have literally zero impact on these societies. It was actually hugely disappointing. When I started investing, I soon realized that investing in the secondary market wasn't particularly helpful when you think of it in terms of the positive externalities and the impact it can have on societies. And so as a result, I ended up thinking more deeply about these issues. You mentioned that I divide my time between teaching and investing, and that it's at that point that I started teaching. I have a true passion for teaching. I taught when I was a grad student at Harvard, and I always knew I wanted to get back to it. And so I created a very unusual course on Asian economies and capital markets that really tries to, seek to understand the impact of the institutional development of financial institutions on societies and also the impact of investments on societies. And so it was part of, in some ways, a personal journey to try to understand these things better. And later on, I created a course on ethics and finance that brought together a lot of these themes that I was interested in pursuing professionally, and just in a self-interested way. A lot of it was really driven by my desire to dig deeper and to learn about it and understand it better and try to apply it in my day job.
You started developing this course, and then when did you start thinking about writing the book, Seeking Virtue in Finance? Was that at the beginning already, or did it just come up over the years as a professor or as a lecturer?
So that was really spurred by my students. So I've been teaching for about a dozen years now. The first time I taught my course on ethics and finance, the first 2 years I taught a course on hedge funds, actually. It was a reflection on their social value, their economic value, their social value. And then I realized that all I was really talking about was ethics and finance. So I created this broader course on ethics and finance. And the first semester I taught it, one of my students halfway through the semester came to me and she said, so this is really interesting to me, but why is it that when we talk about ethics and finance, we always end up talking about bad behavior and people that are self-serving and that are like terrible examples? Why don't we talk about virtuous behavior? Why don't we talk about people that are acting constructively, that are thoughtful? And I thought, of course, why is it that we never point to role models? And so as part of my ethics course, I ended up creating a section of it that was devoted to identifying, analyzing, understanding role models in the industry. And at first, what I did is I invited them to the class to speak to us. And so we'd study their kind of career path and like specific decision points that they made over time. And then eventually, as I tried to find readings for the class, I realized I couldn't find any. Like there was really no literature on this. So I ended up making it my own research project. And I ended up writing this book, Seeking Virtue in Finance, which came out a few months ago.
That's really interesting. And I feel like from the podcast I'm listening to, many people just like, I just didn't find anything on it. So I wrote the book myself. And I kind of want to have for the next couple of minutes this idea. You know Asia a lot, so you know the concept of yin and yang. And I kind of want to bring this to the podcast for a bit now. And one thing that while I was reading your book and like reading a bit into your story was, were there any really bad stories that kind of like stood out that made you try to think this other way? To like, how can finance be a force for good? Anything that comes to mind when I say, okay, what was the worst story that you kind of heard?
It depends. I mean, there's, in some ways for the course, we look at unethical behavior and we try to understand it. And so we do all sorts of case studies in it. At a very extreme, you can think of all sorts of things that are, terrible, like Ponzi schemes, Bernie Madoff and all that. But in some sense, those are less interesting because in any industry, you're going to find people who act illegally, try to take advantage of others in a way that's very extreme. You would never be able to justify because it's just like fraud or theft. So we have a lot of that in the finance industry, but in some ways that's very uninteresting because every industry has some of that. What's particularly interesting about the finance industry, I think, is that it's an industry that's particularly complex and opaque. And there's a lot of asymmetry of information between service providers and their customers, or at least often that's the case. And as a result, there's an unusual amount of space to self-serve. But the challenge is that in finance, you can self-serve in a way that on the surface, at least, can be justifiable. And those are the case studies that I think are in some ways the ones that resonate the most and that For me, I look at them and I say, wow, we need to do something about that. So when you say, what's the most extreme situations, I would say, in some ways, they're the most ambiguous. I mean, in our class, we do, for instance, a 3-hour case study on Abacus, the Goldman Sachs security that the firm created in the mid-2000s in the run-up to the global financial crisis. And those are interesting because they're very nuanced, and they're interesting because those who were the proponents of it, those Goldman Sachs investment bankers, in this case, they viscerally believed that they were doing the right thing. Like there are a lot, maybe not all of them in hindsight, but a lot of the primary actors truly believed that there was nothing wrong with what they did. In some ways, these are the examples that are most interesting and to some extent most outrageous in finance, right? Or if you fast forward to today, Robinhood is a great example, I think, of something that's pretty extreme. So this is the trading platform in the US that simplifies trading for retail investors and allows them to trade for zero fee. And that's a perfect example, I think, of an extreme case of something that is peculiar to finance, where on the surface, the service provider says, we're a force for good. In this case, they said we're democratizing finance. We're actually providing a new service that is better for the people by allowing them to have the same tools as institutional investors and making it free for them, when in reality, they're doing something that arguably you could look at that seems pretty nefarious, actually, because they're frauding people to day trade, which is certainly the vast majority of the time not in their interest or shouldn't be in their interest. So these are the case studies that are more interesting to me than, Bernie Madoff, for instance, the more nuanced ones.
Yeah, I think the Robinhood example is a good example. I'm actually working on my own startup right now to kind of like try to take people a step back from this. It's too easy to trade. Sometimes some things should be hard because you don't fully can grasp what you're actually doing. But I would like to talk about Goldman Sachs a bit longer. You said investment bankers, they actually thought they were doing good. And another example that you also brought up in the book and that I want to talk about because I've lived in Singapore. I spent some time in Malaysia, and it's a country really dear to my heart, is the 1MDB scandal with the $1 billion whale and how Goldman was involved with that. Would you also say that when they did that, they kind of felt they were doing good? Or is this one of the bad cases? And could you quickly just give people a history of what the 1MDB scandal is?
So that's not a scandal that I'm particularly close to, but from the outside, that seems fundamentally different to me than Abacus, where in Abacus, they created complex securities to allow institutional investors to take the short side of securitized mortgages and bet that these securities would decline in value. And so the premise of it was totally reasonable. And so it's the implementation. There were a lot of, in some ways, you can think of them as corporate governance issues because they ended up not sharing enough information with various of their clients, and they did so in a way that was self-serving in the end. The 1MDB case, as I understand it, there's more clearly an element of fraud involved, in the sense that, if I understand it correctly, they helped some government officials essentially siphon, state funds. So it speaks to bad or weak checks and balances within the company, but I think it's a little bit harder for any of those involved to pound the table and say this was completely justifiable in hindsight because there was pure theft involved. And it sounds like there were at least some individual Goldman Sachs employees that went rogue there. So it's a little bit of a different case. I don't want to necessarily overly focus on Goldman as a firm, because in the book I also mention Goldman as a leader, as a fiduciary leader in some respect over the years. There are also great examples about what they did. But there's another example that I think goes to the core of the type of issues I've been interested in, which is the work they did so it was Goldman and JP Morgan did some really interesting work for the governments of Greece and Italy in the late 1990s and early 2000s. And this to me is particularly interesting because in this case, the governments of Greece and Italy came to these investment banks because they had a very specific problem, which was that their debt levels were going above the threshold that was mandated by the European Union. And they wanted these investment banks to help them with that. And what essentially they could do in a short period of time was to obfuscate the fact that they had such high levels of debt. So Goldman and JP Morgan helped them do some financial engineering so that when they reported their sovereign debt levels in the European statistics, it did not look like they had breached the threshold that they were mandated to stay within. And this to me is fascinating because on one hand, you might say that this is exactly why a government or perhaps a corporation might hire super sophisticated investment banks like Goldman and JP Morgan and pay them huge amounts of money, because these investment banks can deliver this kind of rare combination of super deep financial engineering expertise in addition to a really deep understanding of governmental and supranational regulations, right? So it's kind of a rare combination to be able to understand both and to navigate both of these. At a superficial level, you might argue, wow, these banks really delivered on their mandate. They were asked to do something that was really complicated, and they were able to do it, right? And thus, that justifies very high fees. However, if you step back, you would say, well, it's hard to conclude that these investment banks actually serve society here, because in a very narrow way, they serve their customer. And in finance, we're always in the business of serving customers, right? So, and as I think of the different virtues that you might have in finance, there's nothing more important than serving your customer's interests with their interest in mind. And so on one level, they would have served their customer's interest. However, they probably did so by extracting value from the rest of society. Because now the net result is that they masked the fact that these governments had huge amounts of debt. And then, so this was late 90s, early 2000s. You fast forward to 2011, 2012, and now you have a huge Eurozone crisis. And that crisis is really driven by excess debt in the system, excess sovereign debt. And so in hindsight, I'm not suggesting in any way that these banks are responsible for the Eurozone crisis, but they're part of a system that enabled that to happen over time. And so those are examples that I think we need to understand better in finance, which is, things that historically finance professionals have assumed were good for them, good for their clients, and thus good for society. But that's not necessarily the case. So that was one other, example. I mean, you mentioned Goldman that I found particularly interesting. And by the way, as I mentioned, I don't want to pound on Goldman. I mean, they're often they're the brunt of the criticism, but to a large extent it's because they end up often being on top of the league tables and to just be the fiercest competitor out there and draw some of the top talent. But by the same token, I mean, for many years, I hosted John Whitehead in my seminar, and John Whitehead was the co-senior partner at Goldman from 1976 to 1984. And back then, Goldman was seen as a beacon of virtue on Wall Street, and they were the pioneers in what would be seen as very, very strong governance stance. So there's a nuanced picture out there. But to your point, I think Goldman has had its share of issues over the years, and one MDB was, in my sense, was a little bit of an outlier because there was a little bit more of a rogue element to it than some of the other cases that have been talked about.
I think this discussion about John Whitehead is getting really interesting, and it's kind of between yin and yang, right? There's like a good and a bad part to it. And I would like to understand where this blurry line is a bit coming from. It feels to me from what I read in your book, and I'm just making this up, you can never tell, right? But under John Whitehead, something like this whole masking debt and then it falls back on your feet later on seemed to be maybe less likely under some leadership like John Whitehead versus the leadership they had back then. Does it have anything to do with incentive systems or the informal culture that is lived within a bank? And I don't try to pound on like Goldman Sachs, but just maybe you could speak a bit more broadly on what kind of systems might be in place that lead to this ambiguous behavior, let's call it.
Yeah, I think it's worth mentioning that what you're talking about, which is the evolution at a firm like Goldman Sachs, for instance, and the fact that over the years, it seems like the firm appears at least increasingly self-serving, right? There are greater conflicts of interest and there are more scandals or, like specific issues that end up being in the limelight. I would say that's not a Goldman Sachs issue at all. It's a Wall Street issue. It's worth highlighting some of the key reasons why this happens because it's not. And John Whitehead, when he was co-senior partner with John Weinberg at Goldman, that was at a time when a lot of these investment banks were still private partnerships. And when you were a private partnership, you cared a lot more about your reputation. There was a lot longer term perspective that was taken. And you were a lot more cautious, frankly, because the downside was all yours. I mean, it was their money. They couldn't just walk away from these jobs with a sense that they were protected because it was always their name on the door and they had full responsibility. In the early 1970s, you have the first investment bank, DLJ, that decides to go public. And then eventually that leads pretty much all the other large investment banks in the US and then eventually in Europe to follow suit. And there are very few that resisted. Goldman Sachs, to its credit, agonized over this decision for many years. John Whitehead and Weinberg were against it. But then eventually they were the last one or the last very large one to go public in the late 1990s. Now, once you go public, the incentives are very different, and that ended up changing the culture on Wall Street. And when you're a senior manager or the CEO or the senior partner of one of these investment banks, your downside is more protected. Your upside looks more like a call option, and you have greater incentive to show performance over a shorter period of time because your compensation is going to be tied to the stock price. So you have a shorter-term horizon. On top of that, you have greater conflicts of interest because now you're not only serving your clients, but you also have shareholders. Jack Bogle has written a lot about this very elegantly in that you have two principles and that creates all sorts of issues. And then the other piece, which in some ways you allude to by saying John Whitehead and John Weinberg were some of the last kind of bastion before culture changes, but not just at Goldman Sachs and all these firms, is because the focus of profit is really shifts to the trading side. Because when John Whitehead in the 70s and early 80s was managing the firm, the preponderance of their profits still came from the investment banking side and from the type of business where you had to nurture and foster longer-term relationships. It was more the advisory business, the M&A business. And so your core focus is really a client that you have a long-term relationship with. And then over time, the profit shifted increasingly to trading. And trading, of course, now you're dealing with counterparties. So you don't have the same focus on longer term relationships. It's a lot about extracting value, right? It's about just making some trading profits. And then on top of that, over time, you see an increasingly high proportion of profits coming from prop trading. So it's not only just trading on behalf of clients, but it's also trading on behalf of your own account. And that peaked around the time of the global financial crisis. And because then regulation came in and there were a lot of these investment banks were forced out of that business. But all of these things created an environment on Wall Street where the culture of the firms has changed and the outlook was different. But a lot of it is really the incentives. The incentives were, very different on Wall Street. And when I say Wall Street, of course, I'm thinking about it very broadly in the US, in Europe, in Asia.
That is really interesting. It was one of the most interesting parts for me in the book to just see how that evolved. But I'm really glad you kind of expanded a bit on that. And this may be a good segue into corporate governance. And one thing that you mentioned several times was the experience in Japan, right? Where apparently companies were publicly traded, but they went the other way, right? They were way too conservative with their money. Their incentives were just basically as a CEO to pass over the bar to the next CEO, and then my job here is done, right? If you feel like this is a good next step on, say, from moving from the darkness to the light, if we want to stay with this yin and yang, could you describe on where the incentives might be lead to too much conservatism and how that again might be positively impacted by more risk taking?
Sure. I think Japan is a fascinating case to contrast to the US, to some extent to the UK as well, where if you had to pinpoint what's the greatest corporate governance issue in the US or in the UK today, I might argue it's short-term incentives. I mean, it's really like incentives to focus on short-term performance, which often comes at the cost of longer-term performance and also comes at the cost of externalities. There are all sorts of ways in which you can generate short-term performance by extracting value from various stakeholders, by extracting value from your community, from the environment. When we focus on these issues, we have to bear in mind that not all countries have the same culture and approach to capitalism. And Japan is a really interesting one because they, in some ways, they have the opposite issue. Is that you might argue they actually have a horizon that's too long. If you think of what's the ideal for an American CEO, if they think of their kind of idealized path, it's really create a ton of value, have the share price go up a ton, and either acquire other companies or sell their company and move on, right? In Japan, their ideal is to be a steward of a company that will still be around 800 years from now. They just want to be stewards, and they care more about stability, and they care more about the ability to provide jobs to their employees for life. And those are things that are deeply ingrained in the culture. So if you think, if you ask Japanese CEOs, who's their role model? What's the company they admire the most? And it's likely they'll mention some sake company that's been around for 1,000 years. And it's probably tiny. It may be barely profitable, but it doesn't matter. That's who they look up to. And so if you step back, the form of capitalism in Japan is uniquely Japanese. It's on a spectrum where you might have UK, some Asian economies like Hong Kong, for instance, way at the extreme, where we have focus on shareholder capitalism and this focus on like performance and share prices, and we have relatively short-term horizons. In Japan, since the end of World War II, they have this form of community capitalism, which is for them what they care most about, as I mentioned, is long-term stability. And when push comes to shove, they don't really care so much about the returns to shareholders. So if you're a listed company, they're going to care mostly. So of course, they're going to care about their customers because no company can sustainably operate without serving their customers well. But at the end of the day, if you ask them, who does the company work for? Like, what is the fundamental purpose of a company? They will say, or they will at least believe, that it's to generate jobs for their employees. Now, the reason why they're not so focused on shareholder returns is that historically they haven't had to. In the US, if you're a listed company, you have to focus on shareholder returns because if you don't, there's going to be an activist who's going to knock on your door very quickly. They're going to buy up shares. They're going to initiate shareholder proposals. They might threaten to acquire you by buying enough shares to take control. In Japan, historically, listed companies have been shielded from that threat because of cross-share ownership, where when you look at the shareholder list of any listed company historically, you had this peculiar universe of companies that were invested in this listed company for uneconomic reasons because they were. So if you look at the shareholder list, typically what you'll find is there's going to be their primary bank and there are other banks that are going to own shares and their insurance company and their customers and their suppliers. And so you have a whole kind of cluster of companies that hold their shares only as a sign of business loyalty. It's a way to signal that we're going to be partners for the long term. And these relationships tend to be very sticky in Japan. And as a result, we're going to buy your shares. We're not going to care whether your share price goes up or down. We're certainly never going to sell your shares and certainly not to an activist. It's just a sign of loyalty. The consequence of that is that most listed companies historically, they have had a buffer of like safety, a safety net in the sense that nobody could come in and take them over because you always had this large buffer of shares that would never be transacted. So they felt like completely unthreatened by outside minority shareholders. And at the same time, they didn't have the personal incentive to see their share price go up because generally CEOs in Japanese listed companies, they don't have shares in the company, or if they do, it's very small. And their compensation is often not linked to performance and certainly not to share price performance. So that creates a sclerotic system. And it's an important part of, the reason why the Japanese economy and the corporate sector have been in paralysis for more than 20 years. I mean, as you know, the Japanese corporate sector boomed from, in the 50s, 60s, 70s, and it really peaked in the 1980s. And then they went into a dramatic, they built up a dramatic bubble, both in the inequities and in real estate, and that bubble collapsed. And they've been struggling with deflation. And it's really only with the Abe administration, arguably there was a period under Koizumi in the mid-2000s where you saw a little bit of a revival, but it's really the Abe administration that came in 2013 with ambitious policies, and one of them was corporate governance reforms. And that was meant to instill more of a shareholder culture to the corporate sector. And, in fact, that's one of the reasons why. So I've been involved as an investment professional in Asia for over 15 years now, but for the last 7 years, like a large portion of my focus has been Japan. And I've been going to Japan every 3 months. And as part of my responsibility at Cornwall Capital, we have been constructive activists there because there is an incredible renewal taking place in Japan due to these corporate sector reforms that are gaining a lot of traction. Now, this doesn't mean that Japanese capitalism is going to become U.S. capitalism. It's never going to become U.S. capitalism. It's going to be always its uniquely distinct form of Japanese capitalism, but it's going to be more balanced. It looks like it's moving in the right direction. It's probably going to be closer to Canadian or German type of capitalism. But even then, completely different, right? Because German type of capitalism has its own flavor that's uniquely German, but it's a more balanced form that I think is going to be helpful to the Japanese society.
I didn't know you had so much to do in Japan. I'll definitely get back to you for some tips because I'm a huge Japan fan as well. But that's just a side note. Let's move one step closer, maybe away from, we kind of moved from the bad examples in quotation marks over to like a bit too good examples, right? Where it goes into the opposite way in being, in the sense that it's being unproductive. Can you talk a bit about now about like the really productive ethical finance? You mentioned some of those in the books. You mentioned them in the beginning that your student asked about exactly those kind of, those people, those, you know, like the lighthouses that really brought finance in a productive way to a new level and really contributed positively to society.
Yeah, I mean, there are many examples in the book. I ended up writing about 60 or so individuals and firms, but I can, certainly highlight a few. And the way I think about it, as I studied these role models, I really try to understand, well, is there a way to analytically draw lessons from their behavior, the way they made decisions, and so on? And what I did was tease out a framework that we could aspire to follow at least. And so I'll mention, for instance, the first pillar of that framework is serving your customers with your customers' interest in mind, right? And really serving them faithfully, which is not always a done deal in finance, just because so much of finance gives you the opportunity to self-serve, right? You're truly vulnerable to that because of finance is so opaque and complex and so on. And so I can mention the obvious example here in the US, at least, is Jack Bogle. Jack Bogle really made finance better, I should say. So he's the founder of Vanguard. Vanguard was the pioneer in offering index funds to retail investors. He founded the firm in the mid-1970s. He was for the last 40 years or so, 50 years, until he passed away a couple of years ago, an activist in a way. Like, he was agitating in favor of moving retail investors from active management, from having their savings in mutual funds or in other types of vehicles where they paid fees to investment managers, to having them invest in the index, right, in the S&P 500 or in the global MSCI index or whatever, but being passively invested in the index. And what's fascinating about the arc of his career is that it took 40 years for that revolution to happen. It's happened. It's happening now, and we're seeing staggering numbers of flows that are moving out of actively managed investments to passive funds, or so index funds or ETFs. And the three firms that dominate that landscape, which are Vanguard and BlackRock and State Street, are getting staggering flows. And, that really, it happened first as a trickle and then a flood in recent years. But what's fascinating to me about this is that we've known what we know today about the fact that a lot of actively managed investments destroy value for retail investors. We've known this just as well, 40 years ago. All the research came out in the early 1970s, and somehow it took several decades for the revolution to happen. And no one is more fundamental to that revolution than Jack Bogle. And so he created Vanguard. And he not only created Vanguard as a firm that mostly did index funds, but he also created it as a not-for-profit, right? It's a mutual. The company profits are returned to its customers. So by doing so, he decided to forego what would have been a vast, vast fortune, right? He would have been on par with, say, the billionaires who run, the family that runs Fidelity, for instance. But he gave that away when he set it up as a not-for-profit because that was an additional way to reduce fees, right? Because you're already reducing fees dramatically when you're running an index fund as opposed to an actively managed fund because there's no real investment function. It's all essentially back office. You're replicating an index. But on top of that, he's returning profits to its customers. So it's almost, and nowadays, when you invest in index funds or ETFs, there's almost no fees, right? The fees are minimal. So I would argue that he's created more social value than just about anyone in the investment world over the last decades. And it's someone that I've admired tremendously and was incredibly privileged to have him as part of the class for many years until he passed away to share some of his views. So that's one example, but I don't want to overemphasize that example because it's hard to relate to someone like Jack Bogle. And what I was looking for primarily were people we could relate to, right? Because in some ways, Jack Bogle is he's a little bit of a hero. He was also borderline altruistic. He wasn't materialistic. And I didn't want to focus on people like that just because most people are not like that. Most people want to serve society, but they're self-interested. And so that's why a lot of my focus was to find people who were self-interested, ambitious, and successful, but in their own way.
Could you give an example of one of those people or several? And I know that you mentioned the first pillar of your ethical framework, and maybe you could combine this a bit, say, as you said, more nuanced description of somebody, of a role model that has done good for society, but has been successful him or herself. Maybe combine it with telling our listeners what are the other three pillars to lead an ethical financial life.
Sure. I'll mention, so the second pillar is really about serving your customers faithfully, but without extracting value from others. Right? And that goes, and ideally by creating value to the rest of society. And that speaks to these examples I talked about earlier of JP Morgan and Goldman Sachs serving the governments of Greece and Italy, where they serve their customers really well, but they probably extracted value from the rest of society in doing so. And this really speaks to this great movement that we're witnessing today in ESG, which is really a crystallization of this idea that when you invest and when you work in finance, there are externalities. And you have to be mindful of these externalities because there are going to be both positive and negative externalities. And ESG is an incredible force for good because it forces us to be just thoughtful, right? And mindful about what our impact is beyond just simply our customers. There are all sorts of examples out there. I'll mention Frédéric Samama, I think is a great example of someone who was a pioneer in that field. But he was a pioneer in that field when it was hard to be a pioneer in that field, when people saw it as being uncommercial. Because in the mid-2000s and late 2000s, he pushed really hard. So he was still as a senior manager at Amundi, which is the largest European asset manager. I followed his career closely, and I have a tremendous amount of respect for people like him who saw that there was a way to do things in a more thoughtful manner, and in fact that you had to move finance in that direction, but that by doing so, I think most people within the firm saw it as a career limiting move. The fact that he was pushing so hard, what he did specifically was he convened large academic conferences where he invited the leading academics in the field and the sovereign wealth funds and the pension funds. And they were the first ones really to focus on these types of issues. with, my sense was very little support from management, from the management of his own firm. And little by little, he pushed forward the topic, and he was the key person at Mundi, but there were like some academics involved, like Patrick Bolden. And then eventually the key turning point was when he was able to convince the pension fund manager in Sweden of MPhil, which is one of the Swedish pension funds, Mats Andersson, to decarbonize his benchmarks. And this was over 10 years ago, at a time when nobody else did it. That was the first time so they cooperated with MSCI to create a new benchmark that would be an index, but that's decarbonized with very limited tracking error. And, and he created a new path. I mean, and it's him, and there are all sorts of other people. Certainly, like there were folks at BlackRock that were pioneers in that space as well. But those, I think, are the ones that we have to be thankful for when we're seeing the revolution that's taking place today in ESG. So that would be an example in that kind of second pillar of creating social value while you're serving your customers. There's a third pillar. The third pillar is one that I observed amongst many of the role models I identified and analyzed, which is this notion of simply being humane and treating your employees and your colleagues with dignity, with fairness, with humanity, and promoting diversity. And so in the hierarchy, it's less important. And the only reason it's less important because now we're dealing with a constituency that is just simply smaller, because we're really looking at within your organization in finance. But it matters tremendously. And in my mind, it's something that's often overlooked when we're trying to find role models and trying to emulate role models. Is this, the simple way in which they treat colleagues and employees, I think, is extremely important. And here there are all sorts of examples. Of course, one of the biggest topics today on Wall Street is diversity, for good reasons, because there's a tremendous lack of diversity on Wall Street. And if you look at the investment world, it's even more pronounced there. And so, I'll mention as a role model, Natasha Lamb. And I thought it was interesting because what she does, so she's a fund manager at a firm based in North Carolina. And she has been fighting for diversity on Wall Street by initiating shareholder proposals. And she has done it very successfully. At first she started by asking firms, so large listed firms, but many of them were large financial institutions, to divulge and to publish on an annual basis the gender gap in pay. And understanding how men and women are paid and comparing that. And you might say, well, what's the big deal? Like, it's just about like publishing these numbers. And in reality, it's a huge deal because it creates a lot of pressure. And she got Citigroup to be the first bank to agree to publish these numbers. And then, as is often the case in these situations, the competitors followed suit. And so as a result, many of the large listed banks now publish these numbers. And it does a couple of things. One is before they publish these numbers, they hustle internally to try to improve quickly so that the numbers that come out are not completely embarrassing, even though they are really bad. And then once the numbers are out, they're constantly going to be compared to their historical data performance on this and to their peers. And so there's just now institutionalizing pressure for this to improve over time. And it's just a great mechanism, and it's part of a broader theme of Wall Street that we're seeing now, which is the incredible power of shareholder activism and shareholder proposal. And that was epitomized this week by the huge development with ExxonMobil, when engine number one, which was a relatively small shareholder of Exxon, pushed it and got 2 members of the board to go on the board of Exxon and to push for decarbonization. So these are issues that are absolutely fascinating, and they're just going to continue growing. And Natasha Lamb is a great example of that. And then the fourth pillar, in some sense, is the most interesting and intriguing to me because it really stems from this idea that in finance, we're lucky in that the skill set that we derive from being finance professionals is truly versatile. You can apply it to all sorts of areas of the economy and society to be helpful to society, right? And so this concept, it's a concept of citizenship, and it's to what extent are you applying your skill set as a finance professional, but also the network that you've built as a finance professional. And for some that have done well financially, the financial resources that they have been able to create, to what extent are you applying those for social causes outside of your job? And it can be in parallel to your job, or it can be after you leave the finance industry and go on to do something else. So in the book, I talk about many different examples, and that includes people who went on, for instance, and applied their finance skills to become public servants, right? So there are people like Fraga, who was a global macro fund manager, who became the head of the central bank in Brazil, to Robert Lovett, who was a partner at Brown Brothers Harriman in the 1920s and went on to be one of Franklin D. Roosevelt's most trusted public servants in the 1930s and through World War II. I'll mention one example that I think is particularly interesting for younger listeners, and that's Aaron Goddard. And that speaks to the fact that you can do that very early on in your career. Aaron, so I met her maybe 3 years ago, and she might have been 28 or something like that, late 20s. And she had spent 5 years at Ernst & Young in Toronto. And she took a summer off funded by Ernst & Young, and that's really to EY's credit that they would fund something like this, to work for a not-for-profit in Kigali in Rwanda for the summer. She came back from that experience with an insight, which is that developing economies are dramatically hindered by the lack of accounting skills. And that it's a huge obstacle to development, because in a country like Rwanda, there are very few accountants. And as a result, a lot of their companies and a lot of their not-for-profits are run in a loosey-goosey way because few people have a clear understanding of the numbers. And so she left EY and moved to Rwanda to set up an accounting academy. And you fast forward to today, and she's training cohorts of up to 100 students at a time over a 13-week period to make them job ready. It doesn't make them CPAs, but it allows them to fulfill and run the accounting function at companies. And that one person, and she did it with one of her colleagues, she brought one of her colleagues from EY in Toronto, just having a huge impact. It's a very targeted impact, and she's both enabling companies, Rwandan companies, to be better run, more effective, and as a result, that's positive for the economy. She's also creating a path for people to access the middle class in Rwanda. So that's, I think, a great example of someone who uses her finance skills to be a good citizen. So these are the 4 pillars and some of the examples that I've learned from personally by trying to identify role models.
I love the examples, and I have so many more notes from your book and topics that I could dig into, that I would love to dig into, but I want to be respectful of your time and just encourage the listeners, whoever is interested in finding a way to be ethical throughout their finance careers, to check out the book. And for you, JC, do you have any last recommendations, any last words Tim Ferriss would say? Do you have anything that you want to put on a billboard? I think this is a very good topic to give you the chance to, you have some kind of slogan for this episode to wrap this up.
Yeah, I mean, I'm not very good with slogans. I would just say that if you're a younger person in the finance industry, there are all sorts of ways in which you can try to be helpful. I'll mention 3 quick ways in which you can try to do that as you start your careers. One of them is to pick your spot, right? Like, part of the book and part of what I've tried to learn from these role models is an understanding of where in the industry you can be most helpful to society. And then within each area, you can apply that conceptual lens to understand which firms you can be most impactful. So that's one thing. And then the other thing is, as you start your business career, this is a great time to push for transparency. You can ask the pesky questions. It's much harder to ask the tough questions once you've been in your job for like 5 years or 10 years. But in your first couple of years, this is a great time to try to prod your own organization and understand what they're doing about the environment and what is the impact of what they're doing on the rest of society. And then finally, whatever firm you're at, this is a great time because there are movements out there where you can raise your hand and be part of them. And in most firms, they're going to be often a priority right now, whether it's to increase diversity within their own firm. So this is a great initiative to be involved in, or to join the ESG world where it looks like, that's taken over in the process of taking over the institutional investment world. And so there are all sorts of ways for you to feel like you are moving in the right direction and trying to be a true citizen as a finance professional.
Awesome. I think that's some great advice. And for the listeners that want to check out a bit more on ESG, we have plenty of episodes that you can check out. JC, thank you so much for writing the book, for teaching ethical finance, and of course for being on the show today. Thank you so much.
Great. Thanks so much, Andy. I really enjoyed this.
Thank you for listening to the Wall Street Lab podcast. For the show notes and much more, visit us at www.thewallstreetlab.com. To see what we're up to before anyone else, subscribe to our newsletter on our website and follow us on Facebook and Twitter.
Disclaimer. Information contained in this podcast constitutes the opinions of individuals and should not be treated as investment, tax, financial, or legal advice. We take no responsibility for the accuracy of any statements made in this podcast. This podcast is for informational and educational purposes only, and it does not contain an offer to sell or buy any sort of financial products, and should not be treated as advertisement for such. Any copying, distribution, or reproduction of this podcast without the prior permission of the creators of the podcast is strictly prohibited.